Hello and welcome. Today, we're going to decode a tax provision that, let's be honest, every single business owner and professional needs to get their head around. We're talking about Section 30 of the new Income Tax Act 2025. It all comes down to a common business expense, insurance premiums. Let's find out how you can make it work for you. So let's just jump right in with a very practical question. You're a business owner, right? And you've done the smart thing. You've paid the premium for fire insurance on your inventory, your stock. Now, the big question is, can you actually claim that payment as a deductible expense against your business income? What do you think?
And the answer is a clear and simple yes, absolutely. And this isn't just a good accounting practice. It's a deduction that is explicitly allowed by the law, specifically under Section 30 of the new Income Tax Act 2025.
So here's our game plan for today. We'll start by introducing the section, then we'll do a clause-by-clause breakdown, look at a practical example, cover the all-important compliance side of things, and finally, wrap up with the key takeaways. All right, let's get started with the legal provision itself. What does the law actually say? At its heart, Section 30 is pretty straightforward. It's there to allow taxpayers, or as the tax world calls them, assessees, to deduct certain insurance premiums they've paid. Now, the key here is that this deduction applies when you're figuring out your taxable income from your business or profession. The logic is simple, really. The law sees that insuring your business assets isn't just a nice-to-have. It's a real cost of doing business and protecting your livelihood. You know, the devil is always in the details with tax law, so let's really get into the nitty-gritty and break this down clause by clause. First up, we have Clause A. Let's look at the exact wording. It talks about a deduction for premiums paid on insurance against the risk of damage or destruction of stocks or stores. This right here is the clause that directly answers that first question we asked. So what does all that legal jargon actually mean for you? Well, it's simple. First, who can claim it? Pretty much any SSE with business or professional income. What's covered? Your inventory, your stocks or stores. The policy needs to cover risks like damage or destruction, think fire or floods. But here is the most crucial condition, and you really have to remember this. The insured items have to be used for your business. You can't, for instance, claim a deduction for insuring your personal car under this clause. Next, let's look at Clause B. Now, this one is, well, it's highly specific. This provision is carved out especially for federal milk cooperative societies, and it's all about insurance on the life of cattle. Let's unpack this one. The claimant here isn't just anyone, it's a federal milk co-op. The insurance premium is specifically for cattle life insurance. Now notice the ownership structure. The cattle are owned by a member of a primary co-op. And that primary society has to be supplying milk to the federal society. It's a very targeted provision, and it's actually quite fascinating. It's designed to support the backbone of our country's dairy sector by protecting a farmer's most vital asset, their cattle. It helps ensure stability all the way up the milk supply chain. Moving on to the third key piece of Section 30, which is Clause C. Now, this one is incredibly relevant for almost every employer today, as it allows a deduction for premiums paid on an employee's health insurance. So, pretty straightforward, right? The employer claims it covers the health insurance premium for their employees. But, and this is a huge but, here's the critical catch. The insurance scheme must be approved. And who approves it? Either the central government or the Insurance Regulatory and Development Authority, better known as the IRDA. This approval is completely non-negotiable. The idea here is to make sure these schemes are legitimate and offer real benefits, preventing any misuse of the tax deduction. Okay, theory is great, but let's see how this all works in the real world. A simple, practical example should really make this crystal clear. Let's watch this in action. Imagine a company, MS ABC Limited. They pay a 50,000 rupee premium to get fire insurance coverage for their factory inventory. This scenario falls perfectly under Section 30, Clause A. Why? Because it's insurance for stock used for the business. So what's the result? The entire 50,000 rupees is allowed as a business deduction, which directly lowers their taxable income. Simple as that. You know, knowing the law is one half of the battle. Applying it correctly is the other. So let's talk about compliance and some of the common pitfalls you'll want to avoid. This slide lays it out perfectly, the do's and the don'ts. On the best practices side, documentation is absolutely king. You need to maintain all your policy documents and have clear proof of payment. Think bank statements, receipts, you name it. And if you're an employer claiming for health insurance, you have to verify the scheme's approval status.
On the flip side, the common mistakes are what you'd expect. Trying to sneak in a personal insurance claim, completely forgetting about that approved scheme rule, or just having messy records. And let me tell you, poor documentation is probably the fastest way to get a perfectly legitimate claim thrown out during a tax assessment. All right, we've covered a lot of ground here, so let's just take a moment and boil all of this down into the most important takeaways that you should remember.
So, what are the big points? First, Section 30 is your go-to for deducting key business insurance premiums, especially for your stock and inventory. Second, don't forget that very specific provision for milk cooperatives, which is vital for our dairy sector. Third, if you're an employer, you can deduct health insurance premiums, but only if the scheme is approved. And finally, here's the golden rule that ties it all together. Proper documentation and sticking to the conditions are absolutely crucial. Get these points right, and you'll be in great shape. And that's our complete breakdown of Section 30. Thank you so much for joining us today. If you found this explainer useful, we'd really appreciate it if you'd like, subscribe, and share it with others who could benefit.
And as always, our standard disclaimer, this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.